Deepak Shenoy joins in with his take on the markets. Deepak, hi afternoon. Still circumspect, still fearing that volatility and weakness may kick in, or do you think this is what one calls a pre-election rally playing out and this will well sustain us through up until next month?
Hi Aisha, good afternoon. I don't know if this is going to last till elections, but to be fair, there's been a lot of activity, especially from foreign institutions who've been putting in money at a good pace compared to what they were earlier. There's been a lull in domestic investments, but I think that will also pick up. To a certain extent, I don't call this a rally, but more like the market had probably overshot on the downside for a lot of the mid caps and the small caps, and that's kind of correcting furiously. And then we've seen some of the impact happen at the large cap level as well. So it's good. Whether it lasts elections, well, I don't know, to be honest. The bond markets don't seem to be as excited as the equity markets are. So when they are excited as well, I think that's when I'll say this will last.
No, but that excitement of market is because of what FIs are doing at this point of time, Deepak. How would you, comment on what FIs are doing? Because money is flowing into equity, and despite dollar index showing signs of strength around 97 odd levels, we are seeing strength in rupee as well. So what are FIs thinking, which DIs are probably missing out?
So I think the interesting thing here is what RBI did with the swap yesterday. That will probably create a lot more interest. This effectively opens a carry trade for anyone trying to invest in India, because RBI is giving you a fixed swap. We don't know what rate, but if it comes in at 4%, then the differential between borrowing abroad and investing in India becomes only 4% if that was the discovered rate. That is a huge carry, because India's interest rates are way higher than any of the interest rates in the West. If you could borrow in the West at 3%, have a 4% carry, and deploy in India, even in safe instruments, you seem to be able to get 8.5%. You will get a decent 1.5%, 2% carry, which is quite huge, if you ask me. So this will create interest in the rupee, and therefore the rupee will naturally try to correct to while this swap is on. So I feel the rupee remains strong now, despite any external dollar strength, as long as the swap is on, and might carry on based on the discovery of the swap price and the intention of the RBI to do more such swaps.
The swap removes the currency risk?
Yes, what it does is effectively says, listen, you give me, so if you were a bank and I were to tell you, listen, I'll give you $100 million that I have borrowed at 3%. Now you can look at me and say, I'll convert it to rupees, I'll invest it in India at 9%, and but I have the rupee, I have the risk of the dollar running away. If the dollar were to depreciate more than 6% in the interim, they will lose money. So the swaps currently, I mean the exchange rate, the forward exchange rate typically is 5 to 6% above what the current dollar rate is. So it means you're paying 6% a year implicit depreciation assumptions. With a 3-year swap, your assumption will be crystallized into reality, in the sense, if I give you dollars today, you will have to return me dollars, but you know the cost of those 3 years of holding those dollars. It can be converted back to dollars, the rupee, at say a 3.5% per year premium, which means if I do the swap at 77 rupees, current rate is 69, we're talking of in 3 years about 11% depreciation, which translates to 3.5% per year. At 3.5% per year, if I am lending out at 9%, my effective interest rate in dollar terms is 5.5%. Now 5.5% is an awesome rate to offer to anybody in dollar terms, even today. So the discovered, basically the carry becomes a very interesting proposition. People in the last time this was done, this was 2013, we saw this being done at borrowings. People put $10,000, the banks gave them another $90,000 as a loan at 3% interest rates, and they took that money and deployed it in India. They got an IRR of 20 to 24% on their capital. This is the kind of thing that is likely to happen now as well, and therefore keep the rupee dollar exchange rate tilted towards the rupee while this swap is on.
Okay, so that's the strategy that Deepak's following. But let's talk about specific, sectoral themes as well. Deepak, I noticed that you're betting on a potential recovery in auto, and we've all been tracking that, waiting to see if we start to see that breakout despite soft sales numbers across the board. Select names have also been standing out lately on the charts. When you are looking at that recovery, what are you betting on?
Sorry, so we're looking at quite some interesting players in the auto space, not necessarily just manufacturers, but also ancillaries. People like, for instance, Balkrishna Industries, which has been beaten down quite a bit. It's an old favorite of ours. It continues to be on our radar on the buy side. They have actually been trying to circumvent any issues that might happen in the US in terms of blocking Indian imports or introducing taxes on Indian imports by setting up a plant in the US as well. And they have a significant amount of exports to Europe right now, and also at local markets. So that is one company that I feel is useful in to look at from an investment perspective. As a disclosure, we're invested. We're also looking at auto manufacturers in the two-wheeler side. We're also looking at even some of the commercial vehicle plays. I think will start to do well. Not necessarily because they've been beaten down, but also because the business cycle saw a lull in the last 6 months because of insurance issues, because of commercial vehicle axle load increases. We feel the effect of that wanes after February, and in March the data will start to look more attractive. February data was actually a little more attractive than we thought, but still negative. I feel from March to April we will start to see much better data. So I believe recovery of auto will come in. Elections are a benefit, but a very short-term one. But structurally, auto is a very strong bet for us for the next 5 years.
Right. Deepak, with the Nifty Bank at an all-time high, one can really pinpoint the contributors, and it's been the usual suspects: HDFC Bank, ICICI Bank, Axis, and to some extent SBI. Would you be willing to stretch your list aside of these names, and would you go down the B-rung names in banks, or say stick to quality because it's these four which will continue to show leadership even from here onwards?
So I feel the real power is in the next rung of banks, whether it is so we're long RBL, we're long Bandhan through Group, as we've actually bet on the merger here, and we're also positive on City Union Bank and DCB Bank, the smaller private sector banks, if you may. The reason is because I think growth potential is good in large banks, but it's much bigger in RBL and Bandhan, largely because they start from a relatively smaller base, and the way they're doing things, both Bandhan and RBL, actually leads us to believe that they will be super outperformers in the next decade. They will perhaps take a lot of market share eventually from the large banks, and while we don't say that investing in the large banks is bad, we just feel there's more potential here. The smaller banks like DCB and CUB are actually either candidates for acquisition if that ever happens, but more like their standard growth itself that gives them so much room for improvement from where they are, and the fact that many of the public sector banks still aren't capable of performing or gearing up, we continue to feel positive in those spaces. But again, as a disclosure, we've recommended or own these names. We also own a bunch of NBFCs which bet on banks not participating in some of those spaces as well.
Okay. Specific heavyweights as well, we've been looking at today, Deepak. L&T, we started to see a little bit of strength, now it's sitting out again. Reliance, on the other hand, continues to look strong. Some of these are the ones that have stayed on top of the charts, and of course the banking names we've been tracking and we were just discussing as well. On the index, what's the kind of contribution you're expecting when we're looking at at a rally building up potentially ahead of elections?
In the next 6 months?
Yes.
So I think banks are functioning properly because I think we're looking at a lot more liquidity infusion coming from RBI. There's a bunch of new things which is from a resolution perspective. SR has been resolved to a certain extent. There have been more resolutions coming their way. So perhaps end of the corporate, down cycle, if you may. But also the fact is that many of the NBFCs are crippled, they're not lending, so the private banks tend to get some of that benefit. They will do well. The good NBFCs will do well. I believe auto will recover by September. We should start seeing roaring fundamentals. Probably the markets will react earlier than that. And we believe that consolidation in the telecom space will show good results for Bharti Airtel. Again, as a disclosure, we've recommended it. And Reliance will now start moving more towards a digital play than it is currently, which is mostly an industrial play. So in the next 3 or 4 years, I believe that will continue to move. Reliance is a relative underperformer in terms of valuation as when it comes to digital plays per se. So the digital part of Reliance, I believe, will be a game changer in the next few years. So, so that's where I think most of the action is likely to be. L&T and stocks like ABB perhaps and some of the other, capital goods players should do well immediately after elections, because once you have certainty of who's going to be on the throne, if you may, for the next 5 years, people will start capex plans again. A lot of capex has been bunched out, or people have not invested in capex in the last 3 years because of the deleveraging cycle, and that never lasts forever. So people will start announcing new plans. We are seeing a lot of foreign interest in Indian capex by participating either partly or fully in construction projects from both Abu Dhabi, Singapore, and a bunch of hedge funds abroad. So I believe that will drive the capex cycle as well. So L&T and a couple of capital goods players are worthwhile to look at.
Okay. Deepak, I didn't quite get that. You do definitely find a merit in Reliance as a business, but do you believe it can still be bought at these levels?
So it's not really very expensive. If you ask, if you're valuing a DMart at 100 times earnings, and you've got a player like Jio which has come in and literally stolen, top place or maybe second to top place from some of the largest players out there. Yes, it has a lot of debt, but it's also managed substantially more efficiently than many of the other players. And you've also got a retail business that is doing really well. You've also got a bunch of ancillary arms, including the old-time petchem space, which has been doing really well, and I expect it to do really well in the near future as well. Not so much the oil refining, but the petchem area. And I don't see why we would continue to give this a low commodity play kind of valuation when we actually have a bunch of other things out there, and we have a fairly large hoard of cash, and the ability to raise money at 7% today is with Reliance, with almost nobody else now. So given all of these factors, I don't believe it's undervalued. And if you're looking at a 10-year play, these prices are perhaps not as meaningful at a 20 times earnings, 21 times earnings versus what can be in 10 years.
All right. Broader markets have been we've seen a lot of action there, Deepak, across specific names. We've got a lot of volume buzzers, Tata Global, Future Lifestyle, a Blue Star, a JM Financial. We've got stocks at the 52-week highs as well. Muthoot Finance, another one there. UPL also at a 52-week high, and that stock's been looking incredibly strong as well of late. And a whole host of mid-cap banking names as well. So we've actually got quite a bit of action. Indo count we were talking about earlier, on the back of like 7-8 days of gains. Arvind Fashions on upper circuit. So from the broader markets, any of these names that you're also looking at, or anything else that's looking interesting to you and that we should keep an eye on?
Was that for me?
Yes, Deepak.
Oh, sorry. Yeah, in the broader market, yeah, I've been looking at we're long a lot of mid caps. We still feel that there's a lot of potential here. There have been, for instance, we talked about the auto space. We're also long. We're really interested in the startup space. We have been long Naukri, which is Info Edge. One of the reasons for this is not just that it is a cash earning business from its primary proposition, which is the jobs portal and some of the secondary portals like 99 Acres or Jeevan Sathi, but there's also the fact that they invest a significant amount of money into other startups. They own 28 or 26% now of Zomato, and they have a significant stake in Policy Bazaar. And because of this ownership and those companies' ability to raise capital at higher valuations and perhaps provide a base for a higher number of, for instance, Zomato, somebody is talking about now $3 billion plus valuation, which is perhaps even more than what Naukri is valued at. So their stake in these startups contributes to more than half of their market cap right now. And if these startups were to grow even more, you might actually be buying the base business at a ridiculously low valuation. So I feel longer term there is still a lot of value in this. And if you're looking at the startups in India and you're saying that, I wish I had invested in any of these startups, one proxy way to do that is perhaps to buy companies like Naukri, which effectively also is an investor in many of these startups. The other set of investments we're looking at, there's some pharma plays. I can't take all the names, we're still buying a bunch of them. But I think here you should look at companies that have deleveraged in terms of debt to equity substantially in the last 3 years, where the promoter pledging is relatively small and or non-existent, and which have a fairly large runway to grow, but haven't grown in the last 3 years because they wanted to deleverage and protect their turf, and only are now starting to announce plans. Now, I talked about Balkrishna, which did that last year, announced large capex plans for the future. We've seen a bunch of others like GNA Axles. It's a small cap in the commercial vehicle axle manufacturing space, which has also announced new capacity that's been coming in. We looked at JK Paper, a number of paper industries. JK Paper has expanded by buying another paper company in the NCLT at perhaps half of what it would get if it had to build that capacity by itself. And therefore has managed to expand. It's running at 110% capacity today, so the expansion will do it good. So there is a bunch of companies here that kind of meet these criteria, and I think what you should be really careful about is to invest in companies that aren't really so much focused on building PR around media as much as they are in growing their core business, because in a bull run you always find a lot of management very focused on convincing investors to invest in the companies rather than on running their business. I say that just tongue in cheek because we've been through a cycle in the past 1 year where that has failed miserably. We shouldn't hurt on that note in the next 1 year, or next few years. So that's the note of warning that I'd say, and to look at businesses that are deleveraging or have deleveraged.
Deepak, great to have you on the show. In fact, tomorrow morning we're going to be chatting with the Info Edge management. Around 10 a.m. is when the management is going to be joining in, and we will definitely pick up all of these points that Deepak just highlighted. Good to speak with you, Deepak.